David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello, everyone. Beginning with today's podcast, we will begin using this platform to deliver a high-level synopsis update on current trends, market and economic developments in between the delivery of our ongoing monthly video series of commentaries. So let's jump right into the market overview. We're recording this on Thursday, the 6th of August. So yesterday, with the close on Wednesday, the 5th of August, the market closed with a value of 27,201 points. So from the intraday low for the Dow Jones Industrial Average, which occurred on the 23rd of March, the market is higher by 49.35%. Now, it remains down by 5.77% for the year, but clearly we have retraced earlier losses by a great degree. And you can see that on this graphic. As I've said before, I am a visual person, and this graph really puts the last several months into context. I think that it helps to visualize the degree by which we have embarked on this recovery. We all want this to be over. I get that. We want to return to normalcy in our lives. Now, that said, patience remains the key. You can expect that any recovery will also include periods of second guessing and retracing. This is normal and historically common in any recovery from an acute shock. So let's dive into the employment observations on the economic front. The data has changed quite a bit, actually, since our last podcast. Over the last 60 days, we've learned from the Labor Department that 7.51 million new payrolls were created, and on Friday, the 7th, we will receive the latest report for July. That reporting period ran from the 12th of June through the 12th of July. And the forward-looking economic metrics were very strong during that time, so the expectations are for yet another significantly positive report about jobs creation. Now, the graphic you're looking at now is the 4-week moving jobless claims curve from the St. Louis Federal Reserve Bank. The 4-week moving jobless claims average is 78% lower today than it was at its peak on the 18th of April, according to the St. Louis Federal Reserve Bank. There could only be one explanation for such a dramatic decline in this metric that is designed to be smoothed for short-term volatility, and that explanation is that workers are back at work, and they are back at work at an increasingly faster rate. So what about the forward market indicators? What are we looking at here? Well, the stock market, clearly, being a discounting mechanism, is a forward-looking indicator, and it's higher by 49.35% than it was from the intraday low, as it prices the likelihood of an economic recovery into assumptions. But the TED spread also serves as a proxy for bond market sentiment, and we've discussed this in previous podcasts. It currently stands at a very tight 16 basis points, which you can see on this graphic. Now, with regard to opening the economy, within many of our podcasts and videos, we've tackled a two-part question with things that can be quantified. I don't care about the latest conspiracy theory. I'm driven by what I can quantify. Two-part question. A, can the economies of the world open quickly? And B, do so without a second wave of COVID-19? Since our last podcast, we have had a fresh update on the Production Managers Index indices for various countries and manufacturing output, and you're seeing this graphic now. China is at the top. They were the epicenter country. We've talked about how their low points occurred in February. 45 days later, it widely hit the Eurozone, so you see the subset of countries there for the Eurozone, and the United States is down there at the bottom. The answer to the first part of the question remains a resounding yes. We can quantify this by observing the most recent PMI data from across the world. Any PMI reading below 50 is considered to be in contraction territory, while anything above is indicative of expansion. You are either making widgets or you're not, and you can't manipulate that observation. Clearly, China has 5 consecutive months of a return to industrial output normalcy, and one can assume that the only way such could be possible is if workers were not only in the factories, but also healthy. Now again, the Eurozone was about 45 days behind China in terms of its COVID-19 impact, and you can see that on the graphic. China hit their manufacturing in February. Countries like Germany, Italy, Spain, France, the United Kingdom, Sweden, all reaching their low points in the months of April. In Germany, we've seen PMI readings increase from 34.5 to 51. Spain rose from 31 to 53.5, which is significant. France climbed from 32 to 52.4, back into expansion territory. Italy was arguably the hardest hit nation in the Eurozone, and we've seen their readings improve from 31 to 51.9. The low point for the United States occurred about 45 days later than it did in the Eurozone, and as of this week, our PMI manufacturing index has risen to 54.2 from a low of 41.8. And our services PMI rose to 58.2. Both halves of the U.S. economy are back into expansion territory. So to answer part B of the question, we have to observe what we can from worldometers about COVID-19 cases around the world. So to quantify that, let's observe just a few of these graphics. You're seeing daily new cases in Italy, daily new cases in Germany, daily new cases in the United Kingdom. I can show you 33 of these curves. They all look the same. We see no evidence from China through the Eurozone that reopening the economies of the world has touched off a second wave of COVID-19. What makes the United States different at this time has been the widespread incidence of social unrest. Penn State announced today that Beaver Stadium will be empty this year for all of their football games because Pennsylvania has a mandate against outdoor crowds of over 250 persons. Yet, all over the country, we've seen images on the news of hundreds of thousands of people crowding the streets of major metropolitan cities, and ironically enough, the rise of positive cases in the United States correlates perfectly with this period of time. So yes, absent the impact of such mass gatherings, I believe the United States has also reopened its economy, and quickly, without any greater incidence of COVID-19 than we've observed throughout the world as a result. For this reason, I view COVID-related potential as a tail risk to a second shutdown of our economy. I believe that it is very unlikely. The housing market remains robustly strong, and mortgage rates are historically low. The automotive industry is reporting exceptionally strong sales. People who are poor in spirit and poor in wallet don't outbid each other for houses and buy cars. Consumerism is strong, and we can quantify that with retail sales metrics that were up 17.7% in May and 7.5% in June, and corporate CapEx spending that is exceptionally strong. And we can quantify that by looking at new orders and factory orders and observations from earnings reports. From all that we can quantify, it sure does seem like the economy of the United States is recovering strongly, and doing so without an economically related surge in COVID-19, just like we've observed around the world. And it is this that has caused the equity markets to respond so positively since March, and the TED spread to be this tight. If you were a participant on the conference calls in March and dialed into these podcast updates, you've heard me talk about the behavior of shocked markets and how we needed to be mindful of historical behavior patterns at times such as these. You heard me talk about the objective-driven investment strategies, and that over time, those who have had the intestinal fortitude to remain focused on long-term objectives have been rewarded. You are watching that unfold right now. Every recovery from a crisis-induced market low is always characterized by periods of euphoria and then second-guessing. Markets continue to discount the potential for a second wave of COVID-19, and over the next few months, the markets will begin to discount the impact of the November elections. As investors, you must remain focused on where we're going and the objectives that lie ahead of you so that you can rise above this noise and make investment decisions that will be of benefit to you 20 years from now. In closing, we continue to do our series of Zoom meetings. We're having very few in-person meetings. We're doing a lot of conference calls. We're trying to keep people in a 60 to 90-day loop. So please reach out to us. We're reaching out to y'all. This is just our effort to try to continue to lead from the front in this effort to get through this really weird and unique period of time. Thank you for your time in listening to this podcast, and we will be in touch again soon.
David Guttery and Brandon Guttery offer products and services using the following business names: Emeritus Investment Company, LLC, AIC, member FINRA, SIPC for securities and investments. Emeritus Advisory Services, AAS, for investment advisory services. AIC and AAS are not affiliated with Keystone Financial Group. Products and services are limited to residents of states where the representatives are registered. This is not an offer of securities in any jurisdiction, nor is it specifically directed to a resident of any jurisdiction. As with any security, request a prospectus from your representative. Read it carefully before you invest or send money. A representative will contact you to provide requested information. Representatives of AIC and AAS do not provide tax or legal advice. Please consult your tax advisor or attorney regarding your specific situation.